Welcome to Market Brief After Hours. We have got a jam-packed episode for you today, covering a highly dramatic session across global markets, geopolitical tensions in the Middle East, a major pullback in tech, and some high-profile earnings shuffles really shook things up today. Let's dive straight in. What was the headline story on Wall Street?
The headline is definitely the end of the Dow's 5-day winning streak. The Dow Jones Industrial Average dropped 464 points, or 0.5%, to close at 53,885. It was heavily weighed down by Salesforce, which saw its shares drop 3% after announcing a leadership shuffle. The broader S&P 500 also slipped, falling 0.18% to end at 7,710, while the tech-heavy Nasdaq Composite edged down 0.06% to close at 26,348.
So a bit of a breather after some heavy trading. What exactly was driving that tech weakness?
It really came down to disappointing guidance, even when the past quarter's results looked decent. For example, Sandisk shares plunged over 6% after its fiscal fourth quarter results failed to impress. Western Digital shed 13% because their first quarter forecast disappointed investors, despite actually beating fourth quarter expectations. And Apleven tumbled nearly 20% on mixed quarterly results.
Some of those semiconductor stocks have had massive runs over the past year, though. Is this just a case of profit-taking?
Absolutely. Over the last 12 months, Sandisk has skyrocketed almost 3,000%, and Western Digital has surged more than 500%. So a pullback isn't entirely unexpected as traders lock in some of those massive gains.
Let's look across the Atlantic. How did European markets fare amid all this noise?
European equities ended on a mixed note. The Pan-European Stocks 600 managed a tiny gain of 0.16%. Looking at individual countries, the UK's FTSE 100 dropped 0.19%, and Switzerland's SMI finished lower by 0.23%. On the positive side, Germany's DAX edged up 0.05%, and France's CAC 40 climbed 0.35%.
And we saw some interesting economic data out of Europe, too. What is the consumer sentiment looking like over there?
It is a tough environment. Eurozone retail sales fell 0.3% in June, reflecting how the ongoing conflict in the Middle East is dragging down consumer confidence. However, German manufacturing orders unexpectedly jumped 3.1% in June, showing some real industrial resilience. On the flip side, Germany's construction sector is struggling. The construction PMI fell to 42.1 in July, remaining in contraction territory for the 7th straight month. We also saw Switzerland's unemployment rate tick up slightly to 3.0%, and Spain's industrial production lose momentum, growing just 1.1% year over year.
Moving over to Asia, it sounds like the tech pullback we saw in the US really spilled over into those markets.
It absolutely did. In South Korea, the KOSPI index nosedived 4.58%. Tech heavyweights Samsung Electronics fell 6.3%, and SK Hynix plummeted 10.4% as investors started questioning the near-term profitability of massive artificial intelligence infrastructure spending. This is despite South Korea posting a record current account surplus of $49.73 billion in June, driven by strong semiconductor exports.
And what about Japan?
The Nikkei average dropped 0.93%, led by chip and AI-linked stocks. Kioxia holdings slumped 10.2% following that weak Sandisk guidance we mentioned. Also, the yen jumped nearly 3% to a 2-month high against the dollar after a rare joint currency intervention by the US and Japan.
China and Australia seem to have a better day, though.
Yes, China's Shanghai Composite rose 0.57%, lifted by higher gold prices boosting bullion-related shares. However, Hong Kong's Hang Seng Index fell 1.49% on reports that Chinese tax authorities are collecting personal income tax on returns from offshore insurance policies. Meanwhile, Australia's S&P ASX 200 rose 0.47% to a new record high, helped by copper prices hitting a 3-month high and an unexpected trade surplus of 1.93 billion Australian dollars in June. New Zealand's benchmark S&P NZX 50, however, slipped 0.28%, snapping a 3-day winning streak.
Fascinating global dynamics. We need to take a very quick break, but when we return, we'll dive into the latest U.S. economic data, the drama surrounding SpaceX's stop and lock, and a detailed look at the Forex and commodities markets. Stay with us. Welcome back to Market Brief After Hours. Let's get right back into the action. Before the break, we talked about global stock indices, but we also had some key economic indicators drop here in the U.S. today. Let's start with the jobs data.
U.S. weekly jobless claims ticked up slightly to 199,000, which is still in a range that suggests a healthy labor market. Economists were actually expecting 204,000. Continuing claims were at 1.8 million. We also saw non-farm productivity grow at a 1.4% annualized rate in the second quarter. That is faster than expected. And many economists believe that as businesses invest in AI, we will see further productivity gains that could help keep wage inflation under control.
Now, there were a lot of eyes on SpaceX today. Their initial lockup period expired. What happened there?
This is a big deal for early investors who had their first chance to cash out. Over 911 million shares became available for trading, representing about 7% of outstanding shares. The stock has had a rough ride lately. It closed Wednesday at $108.27, which is more than 50% off its mid-June high of over $225. Investors were already spooked after their earnings report showed capital expenditures were more than double their revenue. Elon Musk's personal holdings, which are over 6 billion shares, are locked up until June 2027, but the market is definitely feeling the pressure of this share unlock.
Let's talk about the bond market. Treasury yields were on the move today, weren't they?
They were. The 10-year Treasury yield rose to 4.664%, and the shorter-dated 2-year yield rose to 4.243%. Traders are really focusing on interest rates and geopolitical risks. Higher yields can make stocks look less attractive, so this is keeping a lid on equity prices ahead of the big non-farm payrolls report.
And speaking of geopolitical risks, oil prices jumped today. What is the latest with the Strait of Hormuz?
It is a highly volatile situation. There were reports of a draft plan from Iran that would ban U.S. and Israeli ships from transiting the Strait of Hormuz. We also had reports of attacks on Saudi tankers in the Red Sea and explosions heard near a tanker off the coast of Oman. This pushed Brent crude up 3.8% to close at $82.48 per barrel, and U.S. West Texas Intermediate up 2.8% to $77.29. However, there are still talks behind the scenes between Iran and Oman to reach a deal to reopen the strait, so the market is caught between hope and caution.
Meanwhile, natural gas went the other way.
Yes, U.S. natural gas futures slid about 2% to a 14-week low of $2.62 per million British thermal units. That was triggered by a bearish government report showing that energy firms added more gas into storage than usual for the third straight week.
Let's pivot to currencies and precious metals. We've got some key technical levels to watch. Let's start with Euro-USD.
The Euro-USD pair pulled back, closing down 0.27% at 1.1523. The daily candle showed some clear selling pressure after the pair was rejected near its 100-day simple moving average, which sits at 1.1569. Even though the short-term trend has shown some recovery, the failure to break above that 1.1560 to 1.1569 resistance area suggests supply is still heavy. On the downside, the 50-day moving average at 1.1474 is providing strong underlying support, while the 200-day sits way up at 1.1628, keeping the longer-term downtrend intact.
What about the British pound? It seems to be holding up a bit better.
Yes, GBP USD is consolidating near its recent highs, closing down just 0.10% at 1.3454. It's trading in a very narrow, indecisive range, but structurally it remains quite bullish. The pair is holding comfortably above all its major moving averages. The 50-day is at 1.3364, the 100-day is at 1.3405, and the 200-day is at 1.3401. These moving averages are aligning favorably for the bulls, and as long as the price holds above the 1.3400 pivot zone, the setup looks constructive for another breakout attempt.
And USD JPY saw a pretty dramatic reversal, didn't it?
It did. USD JPY rebounded strongly, closing up 0.43% at 158.42. It formed a bullish engulfing candle on the daily chart, successfully reclaiming the crucial 200-day simple moving average at 158.01. Even though the medium-term trend has been bearish, finding dynamic support around the 157.00 level and the 200-day average has given buyers a near-term floor. However, the pair still faces significant overhead resistance, with the 100-day moving average at 159.99 and the 50-day at 161.19.
Let's look at commodities. Gold and silver both had some interesting technical sessions. Gold seems to be pausing after a massive run.
Exactly. Gold closed virtually flat at $4,249, down just 0.03%, printing an indecision doji candle. This comes after a massive rally in the previous session. Gold has managed to pull away from its 50-day moving average of $4,169, but it's still trading well below its 100-day moving average of $4,413 and the 200-day at $4,482. It looks like the aggressive buying momentum has temporarily exhausted itself, and we might see some sideways consolidation above the recent low of $4,224.
And silver faced some pretty tough rejection at a key technical level.
Silver fell 0.64% to close at $61.64. During the day, it tried to break above its descending 50-day moving average at $62.81, but sellers stepped in and pushed it back down. Silver is still entrenched in a medium-term downward trajectory, trading well below its 100-day moving average of $69.35 and its 200-day at $70.31. Immediate support rests at $60.88, and holding above that level is key to keeping this current consolidation phase alive. Meanwhile, U.S. natural gas futures also took a hit, sliding 2.2% to a 14-week low of 2.629 billion British thermal units, following a bearish storage report.
To wrap things up, let's run through some of the biggest individual stock movers of the day. We saw some massive double-digit swings.
We certainly did. On the downside, Datadog plummeted over 18% after reporting a second quarter adjusted gross margin of 80%, which was just slightly below the consensus of 80.7%. HubSpot dropped more than 19% on weak third quarter revenue guidance. Celsius Holdings also shed over 18% after its revenue missed expectations, and Zillow fell over 7% after a downgrade from Evercore ISI, citing a weaker macroeconomic environment.
But it wasn't all bad news. Who were the big winners today?
Paycom Software was the star of the day, surging more than 23% after raising its full-year revenue outlook above consensus. And Unity Software jumped over 15% after posting second quarter revenue of $546.5 million, which easily beat expectations.
An incredibly action-packed day across all asset classes. That brings us to the end of today's episode. If you find this useful, please follow Market Brief After Hours. We will see you next time.